Here is the one reason why you are not getting better at trading. It's not the time you invest, not the effort that you're investing, maybe not even the skills that you have. I think most people think about trading, think about crypto in the wrong manner. Most people don't know how to judge their decisions, independent from the outcome. So think about the following. You buy a house, right? Let's make it super tangible. You're buying a house and you hold it for a few years, and then after a few years, maybe the value went up a lot, and then you sold. Simply maybe to upgrade to another house or maybe to move, whatever the reason is, you're simply just selling. And then you hear several months later that maybe a garbage burning facility will be built very close to that house. And so the value of all of the houses in the neighborhood plummeted. And then you say something like, it was a really good decision to sell that house because afterwards the price went down. Do you notice an issue here? The issue is that the reason for selling the house was not your foresight that in the future that garbage facility will be built. The reason for selling the house was completely independent from this. Your decision had nothing to do. The quality of your decision was completely independent from the outcome. But most people judge their decision based on the outcome. As in, you might have bought Bitcoin today, you sold it maybe a few weeks afterwards, you sold it for a higher price, then Bitcoin crashes, and then because you sold just at the right moment, people think that decision was right. But maybe you didn't really know why the price went down, right? Maybe it was just a random hedge fund that had to liquidate their assets, thus depressing the price, and there was no way to know beforehand that hedge fund had to sell. And you definitely didn't sell because of your foresight of that hedge fund having to sell. So what do we need to focus on? We cannot judge our decisions based on the outcome for most games that involve luck as well. So you've got two components to the game. You've got a skill component and a luck component. And the way how I learned about this is via poker. I used to play online poker for a while. And the people that play this professionally, they talk about all kinds of situations, right? They talk about, I'm holding this hand. These are the potential hands that my opponent could hold, right? They're just thinking about all kinds of logical ways what an opponent would hold in a certain situation. And based on those considerations, you come up with probabilities. Should you bet money? Should you call the bet? Should you raise the bet? You're thinking about all potential outcomes, give them some kind of probability, and then based on that, you make your decision trying to optimize the expected return for you. So this is what happens in poker. Now, when people discuss poker strategy online, right, when they're discussing an individual hand, an individual situation, they will talk about, obviously, the own hand that you have, the own card that you are being dealt, and they will talk about the overall situation, like this is the cards that are on the table, and this is how other players at the table have behaved. But what they will not talk about is the outcome. The outcome is completely removed from that discussion. It's not even shown. In other words, completely independent of whether or not you won that game, you won that hand, a decision might have been right or wrong. You might have won the hand, but still made the wrong decisions, or you might have lost the hand, but made everything right. Because there is always a bell curve of outcomes. There's always several different kinds of outcomes. And yes, the other opponent might have had double aces, and yes, that might have been one of the possible scenarios. But maybe there had been so many other scenarios that it's still okay to take that bet. There is still a high likelihood that he doesn't have those double aces. He could have played all kinds of other hands, all kinds of other cards the same way. And so you have to take the bet, you have to pay, you still lose, but it was in the end the right decision. It was the right decision based on the probability. So you are decoupling your decision making from the outcome. This is super common knowledge within poker. It is not common knowledge whatsoever in the investing world, especially in the crypto world. So crypto people way too often judge their decisions based on the outcome. So what should we do instead? we should focus on expected values. Now with poker, that's relatively straightforward, right? You know, those are the kinds of hands you could have. Those are the kinds of profit/losses we would do in each single situation. And so you come up with a monetary value directly. You can calculate expected values in a lot of situations. So in poker, it's more straightforward. In crypto, potentially not. But in crypto, we can still try to estimate whether or not what we are currently betting in the market has a positive expected value for us. So one approach, for example, that we follow here in the premium membership is we look at other influencers, or we look at other venture capitalists, and we look at what was their historical win rate. How successful have they been? How many trades did they do? Did they make hundreds of trades? And over that relatively large sample size, we see a winning rate of 70-80%. Then probably copy trading is the strategy with positive expected value, right? We can't be sure, but at least it's better than just randomly throwing up a coin. Or let's say we buy because we saw another YouTube influencer buying, right? We track all kinds of wallets in premium. We saw, okay, YouTuber ABC bought that token. Then we can look at the history, and we can look at how often did he promote his coin when he bought it beforehand. We can check how reliable is that signal. We can check how much would he potentially influence that token's price, right? Because let's say he buys only a small micro cap, then just a few thousand views could potentially already move the price. If he's buying a very large asset, then that might not be the case. Now, in the end, we do not know the outcome, right? We do not know if the influencer is really going to promote the coin. And if he is going to promote it, how many people will actually find it attractive to buy? We do not necessarily know if this trade works. But we do believe there is a positive expected value, right? If we just were to randomly draw lines on a chart and we buy based on that, we probably have a 50-50 split, maybe a slightly better, or let's say 51-52% winning probability. But if you know that an influencer tends to promote a coin after they bought it, and you saw this in 80% of the cases, and you saw this in even more cases, that whenever he promotes that the price shoots up, then suddenly you've got the odds in your favor. That doesn't mean that even though you made the right decision, you will always make profit, right? You can make the right decision and get the wrong outcome, but it means that over large enough of a sample size, you're winning. So do not necessarily look at the outcome of the investment, of the bet you take. Instead, try to find a system to estimate the probabilities of something happening. You can do this very mathematically. You can run back tests on technical indicators. I've done this on this channel as well, right? I've calculated back tests on the best moving averages. I've calculated back tests on relative strength indicator signals. I've done those kind of things. But I'm also trying to figure how often does it make sense to buy together with another influencer that we're tracking? Or how often might it make sense to buy a token when a venture capitalist has just bought? What's the win rate of that venture capitalist? Or does it maybe make sense to follow this other random wallet where we don't even know who's behind it, but where we see historically most of the time this person bought very early and made money, right? Or maybe not even most of the time. Maybe he loses in 70-80%, but in the 20% where he doesn't lose, he makes 10-20x returns, and then it would still on average be a positive expected return bet. So that's how you improve your skill over time. You don't improve this simply just by reading more crypto articles or by watching random YouTubers, except of course this channel here. You improve your skills by figuring out what are my expected values. How can I estimate probabilities? What could I attach the probabilities to? And how can I potentially measure this? And once you do this, once you quantify things, once you measure things, once you don't judge things anymore based on the outcome, but you judge your decision solely based on your model, and you can simply just run a lot of sample size through this. You can simply just do those kinds of trades over and over again, and in the end, you will win. Right? That's the whole idea. This is why casinos exist. On a roulette table, you might have a win to loss ratio of, 48% to 52%. So it's almost 50-50. It's just the slight edge that you give to the casino, but simply because the casino has such a large sample size. If you just play it for long enough, then you will for certain lose. It's the same way how we make money in poker, it's the same way how we are making money here in crypto. We do not look at the outcome, we look at probabilities, and we try to find ways to estimate the probabilities to the best of our ability. So this is how you get better over time. You don't get better just by putting your hand in the sand, by following random people that you see on Twitter. You get better by having a systematic approach to determine what your expected value is. If you found this useful, feel free to give this a like and feel free to subscribe as well. I publish videos regularly. See you next time. Cheers.